Are you on the lookout for opportunities to invest in dividend stocks that hold promising potential? Curious about the market's offerings and seeking guidance on the best choices available? In a world of varied investment options, are you interested in discovering the remarkable dividend stocks that could offer substantial value and returns? Wondering which dividend stocks are positioned favorably for today's investment landscape? If so, explore this insightful video of amazing dividend stocks to buy today and uncover the potential gems awaiting your consideration. Verizon Communications. Despite its position as the third largest holding, this particular stock is presenting an opportunity for investors due to its trading at a substantial 38% discount below its estimated fair value. This noteworthy undervaluation renders it an appealing prospect for investors seeking favorable deals in the market. The stock's current undervaluation can be attributed to a prevailing market focus on Verizon's challenges concerning the expansion of its postpaid consumer cell customer base and its involvement with lead sheath cabling. While these concerns hold validity, their impact appears to pale in comparison to Verizon's impressive performance during the second quarter. The completion of ongoing network projects and a gradual decrease in promotional activities will contribute to Verizon's enhanced margins and strengthened cash flow. A key point of interest is that a significant portion, ranging from 50% to 60%, of Verizon's free cash flow is allocated towards sustaining its dividend. Pfizer. Pfizer is another big player in the world of dividend stocks. The stock is currently trading for about 25% less than its expected fair value, which could mean that the market is undervaluing it. The market seems to underestimate Pfizer's ability to make up for large patent losses over the next 5 years. Recent second quarter results were not as good as expected because sales of COVID-19 vaccines and medicines went down. Conover says that Pfizer has made plans to cut costs if COVID sales do not pick up in the third quarter. Even though there are a lot of unknowns, Pfizer's dividend allocation seems right and is in line with the company's goal of giving out nearly half of its normalized earnings as rewards. This puts Pfizer on track to meet the reward standards set by industries that have been around for a long time. Comcast. At this moment, the stock is selling at a price that is 22% lower than its estimated fair value. The net loss of internet customers was less than expected, which shows that Comcast did better than expected in the second quarter. The company's strategic positioning is based on its ability to stop losing market share on the internet and its strong pricing power. Comcast started giving out a dividend in 2008, and every year since then, the dividend has grown by an average of 17%. The company's financial health is shown by its strong balance sheet, and it has always been committed to giving owners value. Wells Fargo Bank. The stock trades at a big discount of 28% below its estimated fair value. Wells Fargo is the only bank in this group of dividend stocks, which is another thing that makes it stand out. Even though costs went up, Wells Fargo was able to do better than expected in terms of net interest income in the second quarter. The bank has a strong balance sheet, and its dividend plan is good. Wells Fargo's current approach to dividends is in line with industry standards, and the bank has also shown that it can buy back shares effectively. During the most recent quarter, these repurchases added up to about 2.6% of all outstanding shares. This shows that the company was smart about how it used its cash. Medtronic. Medtronic is a leader in the medical equipment market. The stock trades at a big discount of 26% below its estimated fair value, which could make it a good choice for value buyers. As the biggest company that only makes medical devices, Medtronic is important because it is a key partner for hospitals and has a wide range of products that treat a wide range of chronic diseases. The company wants to spin off some businesses that will focus on patient tracking and respiratory innovations. This is likely to move the company into markets that are growing quickly. This change fits with the strategic goal of the company. Also, Medtronic has an amazing track record. For 46 years in a row, the company has raised its dividend. Gilead Sciences. The stock is selling for about 18% less than its estimated fair value, which could be a sign of market mispricing. The company is known for its high profit margins, which come from its focus on HIV and HCV in its business. Gilead has a wide Morningstar economic moat rating, which shows how competitive it is. This is because it has a large portfolio and a strong pipeline. The second quarter numbers showed how strong the company was. Over time, Gilead's dividends have steadily gone up, and the payout ratio has stayed around 50%. Dow. At the moment, the stock is selling at a discount of 23% below its estimated fair value. This makes it an interesting prospect for value investors. Dow is one of the biggest chemical companies in the world. It has a small economic moat, which is helped by the lower costs it gets from making ethylene and propylene in North America. Even though the economic slowdown caused problems for Dow and hurt its performance in the second quarter, the market is expected to improve along with the rest of the world economy in 2024. In the last 3 years, the company has paid dividends of $2.80 per share, and experts think that this will continue. Management is expected to keep the bonus and make getting it out a priority going forward. Wec Energy. Wec Energy is a big player in the controlled electric utilities market. The stock is selling for 10% less than its estimated fair value, which makes it a good choice for buyers who want to get a good deal. As the biggest utility company in the Midwest, WEC has strengthened its position by building a narrow economic moat. It did this by taking advantage of service area monopolies and economies of scale. The company's steady success is due in part to these things. The company's dividend allocation strategy is good. With a payout ratio between 65% and 70%, WEC's promise to give value back to shareholders is in line with the company's high-quality, safe, and regulated assets. This shows that the company has a good plan for allocating its capital. DTE Power. The stock is a cheap prospect in the utilities sector because it trades for 8% less than its estimated fair value. Changes to Michigan's utility regulation and a strategic shift in the company's business mix have set DTE up for a long time of growth investment opportunities. After milder than normal weather in the first half of 2023, however, the company is likely to keep focused on lowering operating costs. The company's plan to raise dividends by at least 7% per year over the next few years shows how serious it is about payout growth. This approach fits with DTE's goal of increasing shareholder value consistently and over time. PPL Company. Presently, PPL Corp stock is available at a price 10% below its assessed fair value of $29 per share, indicating a potential market mispricing that might capture the attention of value-oriented investors. This discount could be indicative of an advantageous entry point into a stock that offers substantial growth potential. PPL Corp operates within a narrow economic moat framework, attributed to its role as a holding company overseeing utilities across Pennsylvania, Kentucky, and Rhode Island. The company's strategic positioning is further fortified by the support of robust regulatory bodies that underpin its services, contributing to its stability and competitive strength within the sector. In terms of dividend strategy, PPL Corp aligns with industry norms by targeting a payout ratio ranging from 60% to 65% of earnings. This approach is well suited for a company that operates within the domain of regulated business, which is characterized by its stability and high-quality nature. The company's commitment to maintaining and potentially growing its dividends underscores its focus on delivering value to shareholders. Going forward, PPL Corp's promise to continue its dividend payout stands as a testament to its financial stability and confidence in its regulated business model. As such, investors can reasonably anticipate a steady stream of income while maintaining confidence in the company's financial health. This commitment to dividends is expected to be upheld in conjunction with a strong balance sheet, creating a favorable environment for both current and potential shareholders. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.